You may have decided that you want to invest in a particular sector. Now you may be in the position of choosing between buying stocks or an exchange-traded fund or ETF. Making this choice is no different from any other investment decision. In this video, we'll look into ETFs and what makes them different from stocks. ETFs usually offer exposure to dozens or hundreds of different listed companies by tracking index or specific sectors. Investing in individual stocks involves buying shares of a company. Because of the larger number of stocks that ETFs accumulate, usually they have lower volatility compared to stocks. Thus, they can be considered less risky than investing in just one company. Some index funds track the price of movements in entire stock market indices, which include dozens to hundreds of stocks of different companies. Individual stocks are usually much more volatile than ETFs. Here are the key factors of stocks. Analysis and research may require more time. There could be higher volatility. The risk that the stock you own will not beat the return of the overall index, the risk associated with events and the valuation of a single company, the risk premium may be higher, and the possibility of beating the market's performance. Here are the key factors of ETFs. Diversification of investments and lower volatility, time savings, exposure to stocks of dozens or hundreds of companies at once, the ability to choose from funds focused exclusively on a particular region, freedom of exposure to a selected market sector and lower volatility, risks associated with a broader decline in equity market sentiment, and the risk that a particular ETF will perform much more poorly than the strongest stocks. So what are the pros and cons of investing in ETFs? The pros include it's great for long-term and passive investing for both beginners and professionals. There's a low entry barrier and low fees or TER and high liquidity. Limited risk and possibility of portfolio diversification. Due to diversification, volatility may be lower compared to single stocks. There's the possibility of investing in a bunch of assets like indices, bonds, or commodities. And investors may be sure that index funds can have a similar performance with stock indices, for example, the S&P 500 or the Nasdaq 100. The cons include they may not be appropriate for traders and short-term investors who prefer an aggressive investment style. Their lower risk is balanced by possible lower returns. Investor-selected ETFs may underperform compared to top companies or indices during bull markets. Diversification does not guarantee returns and can also lead to losses. In a portfolio, a few ETFs can spoil the performance of those that are doing well. There's the risk of misalignment of ETF in a portfolio, and excessive concentration of capital in passive investments can limit allocation options towards riskier assets and the possibility of outstanding returns. XTB offers 0% commission on stock and ETF investing, and you can get started by downloading the XTB app on the App Store. Subscribe to XTB to learn more about trading and investing.